Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, August 1st, or we'll call this Apple Day. We'll call this Apple Day for the obvious reasons. Apple reported earnings last night, largest component of the Nasdaq 100, largest component of the S&P 500, and it depends what if you're a trader of the broad markets or any of the index ETFs or futures like the Nasdaq 100, you probably noticed Nasdaq was up today, and so really what happened here before I get to those charts, let's take a look at Apple. This $200 level, that's not a resistance level. It's just where we were. I did a video for members of the site this morning before the market opened. Apple was trading right around 200. So you can see it really didn't build on those gains much. It closed at 201.50. That's statistically insignificant, really, right about that $200 mark. We'll call it whatever. It doesn't mean much. It's a round number. The stock's at new all-time highs. So what that means when stock breaks to new all-time highs, there's typically not any resistance overhead because you don't have any price levels or reactions at that level. Everybody in the stock at that point in time is above water, but we'll see what happens. And what I mentioned this morning is, I've had these lines moved up. That's why I put the $200 mark there. We can take that away now, just to point out that the divergences are not even close to being negated yet. They haven't played out at all, but they haven't been taken out either. So there's the negative divergences. The lines might have been about right there yesterday, so we lift them up a little bit. It gives Apple even some more upside if it wants to continue to rally and still have some pretty powerful divergences on the daily and the more significant weekly time frame as we look here. And again, I've gone over this chart in the past. You can see every single negative divergent or divergent high going back throughout the past decade. So that covers this entire bull market. And there's your double digit gain drops each and every time there, 26%, 15, 16, 45, 34. So we have a big divergent high here. And will these divergences play out as they normally do in the form of a trend reversal or correction? Maybe. I'd say yes, statistically speaking. More often than not, the divergences do, but they don't have to. So uh, take it for what it's worth. I know we all have our own opinions on Apple, but until these divergences, and more so, let's look at the whole market because Apple, again, it's just one stock. I don't want to put too much into this one stock, but let's talk about what the markets did today. All right, so QQQ, which most of us know Apple is the largest component of QQQ. QQQ is a flawed index, in my opinion, and as well as some others. It's too top heavy weighted with the top components. Apple's the largest. So we had a nice showing today, up 0.38%. Nothing stellar. And again, that is, I'm not going to say solely attributed to Apple because technically speaking, that wouldn't be correct, but it was largely attributed to Apple. And the proof is in the pudding here. If we look at, there's QQQ. If you look at the upper right-hand corner on this chart, you can see the percentage gains right there, 0.38. So let's just look at QQQE, which is the equal weighted NASDAQ 100 tracking ETF. That's the equal weighted NASDAQ 100 index. So Apple is in there with all the same roughly 100 companies, 103, I believe, to be exact, and or at least 103 different securities. Alphabet counts twice. They have two share classes, GOOG and GOOGL. So totally, I have 103 in there right now. And you can see this was down 0.54%, so a more significant drop, a larger drop than we had a gain on the overweighted Apple overweighted Nasdaq 100. And to just round the corner here, and make sure we take a look at everything. There's SPY down 0.16%. You have the mid caps, MDY down 0.32. You have the small caps, IWM down 0.07. You had the Dow down 0.42. So there's not a single index other than QQQ, again, and due to its flawed weighting. The rest of these, they do have market cap weightings in some of these other indexes, but not nearly as much. There's much more balance in the Russell 2000 and the Dow and some of these other ones. So there it is. You can see the statistics for what the market did today, or what the market really did. The market, I should say, the stock market, not one index. And it was also worth noting as far as market breadth goes, at least on QQ. Let me see, on the Dow here, we have 11 of the 30 stocks traded higher. So with 19 of the Dow stocks trading down, and let me look at QQQ. I have a watch list off to the left or to the below the screen you can't see, and I can quickly sort these and tell you that. Almost there, folks. Boom. We had out of the 103 securities or holdings in QQQ, only 40 of those traded positive today. with the remainder. A couple were flat and most were down. So that's the market. Now, with that being said, that's not a big down day. We had, again, most of the index, so we'll call it a slightly down day, nothing big. And let's look at the charts and then we'll wrap it up because there's not a lot of new developments. I won't go over the daily charts. There's nothing new to report there. 60-minute charts, what I've been highlighting recently is this potential bear flag pattern, but I can tell you it's getting a little bit stretched. This is a bear flag relative to the flagpole. You can either look at this move down or you can take it from the move off the high. And it's still there, but it's stretching the upper limits of symmetry. I like my flags personally to be a little smaller and tighter compared to the distance of the flagpole there. But with that being said, more importantly, is that so far the Qs have failed at that resistance level there, about 177.69. We're going to look at the futures here in a second, but this was a pretty significant level. Here were your previous highs in QQQ. Let's try to highlight these. Reaction high, failed. We tried at it again, failed, but then finally broke out. So that's good. It broke out. We back tested one, successful. Back tested two, successful. But now that back test has failed. That proved to be, or this whole move here, that breakout is now, we can say in hindsight, a failed breakout. Whether it's going to be prove to be a bull trap or not, we haven't seen impulsive selling. We did get that drop, the impulsive initial move down below there. But again, we're back testing it. So I think this is a pretty significant battleground between bulls and bears. Bulls want to regain that level and obviously take out the previous highs. Bears want to see another move, especially impulsive. If this is going to turn out and prove to be a bear flag continuation pattern, you want to take the measured move, take either the highest part there or this part of the flagpole, add that to the top of the flag. And now, again, this thing is getting long in the tooth, the flag, so we're going to have to break down soon, and I'm talking as in tomorrow, in my opinion, for this to really count and work. So there it is. If it does, might take us down to that T3 zone. That's QQQ. Let's look at SPY for you SPY traders. And we have a similar story here. Bearish rising wedge and divergent high, everything that's been covered recently. Let's go to a cleaner board here just to make things stand out a little, pop a little easier on the eyes. All right, this is what I'm looking at here. We had a level right about here. Now, that's what stands out to me. What is that? Well, we had the high back here in the SPY, not the all-time high. That came in January. We still have yet to take that out. Tried at it again. Finally broke out right there, back tested it, and then boom, started moving or back testing again. So unlike QQQ, SPY has held its breakout so far. Hasn't really started walking away impulsive, and a lot of that is tech dragging it down. Remember, the SPY is not nearly as heavy in tech as QQQ. However, it is the largest sector within the S&P 500. So, as I often say, this market, tech took this market up. And I can tell you this market's sure not going very far. Yeah, there's all this buzz about sector rotation. I see that. I acknowledge that. But again, it comes down to weighting. So you have the largest weighting in the S&P 500 is technology. So it's going to be very hard for this market to push on and go on and make new highs, take out those all-time highs in January without technology, coming along for the ride. So that's pretty much it. Just watch that level again, where I think we're at a pretty significant area. There's a little more downside for the SPY to test that. So we'll call it about 279.45 or so. And if it goes and the bear flag that I showed you there on QQQ a minute ago, if that were to break down, we can look at a move down that might take the SPY also down to any of these target zones. Maybe that T3 target. This would be my preferred target if we start to see some bearish action. And I've said this before, if you're bullish and long or wanting to get long, wanting to buy a dip, well, this certainly is a very objective level. That's again, the breakout that we had back in July. Maybe that level will hold. We continue on up. As I showed you, QQQ has already hit my target yesterday and has reversed since. So this was or Monday actually. And more so on NQ. Let's get to the futures. I really like these futures charts. They're pretty clean, and that's what I've been trading recently. Okay, so this is the NQ, the NASDAQ 100 E-mini futures. Pretty clear patterns and trend lines and things to look at. And this was the most significant, our most recent rising wedge pattern, complete with the negative divergence that I like to see to confirm the bearish nature of a rising wedge. Just like we had a rising wedge back here with negative divergences at the highs, we had a breakdown back test, and then that one played out, ended with a divergent low, which is bullish. That's led to the next rally. And then the bigger picture, as I've covered recently, was this basing type pattern right here. When we put in that divergent low, we started to move up, making a series of higher lows, and finally we took out the top of that range. So you can see that whole basing pattern there, late June, early July. You also had reactions from above back here, and so this was my pullback target on NQ, and that's where I reversed and went from short to long, and I'm out of the longs now, and I'll talk a little bit. I talked about that to members of the site, what I'm doing with my positioning, but this is my, I should clean all these lines out and make clear again if I didn't do it in the last public video. This is my bounce target zone, these three levels right here. Each are individual resistance lines. They're in a cluster in close proximity. So they run from 72.89 to 73.23 roughly, and 73.59. So far, we've had several attempts here at that first level, and we have the NQ has not been able to break out that above that level. We've had a few intra-session pops. Remember, these are 60-minute candlesticks here. So that's it. And what I'd be watching, and I am watching, is for a break of this uptrend line right here. You have a minor uptrend line off the lows. Not super significant, but it's there. And again, when we hit that target on Monday, which was again the top of that zone and these two the support levels, we did so with bullish divergence in place, which was, helped to confirm this rally and really was the catalyst or the fuel to carry us up there. But so far stalling there. So that's it. I can't say much more about it. It's a battleground right now, near term between bulls and bears. If we take it out, the bulls still have quite a bit more work to do. And as long as we remain above that or below that 73.59 level, especially on a closing basis, I don't care much, I'm not too concerned with brief intraday pops, intra-period pops, but anything much above that, and that sort of diminishes the bearish case. So, as I mentioned before, if you're a dip buyer, well, this was a golden opportunity to go long right here if you're looking for new highs. And even if you're just looking for a swing trade along with some more upside, what you want to see is each of these levels get taken out, ideally impulsively and or on a 60-minute close. And of course that one as well, and there might be some more upside. So if you're long, you can always trail a stop, let your winners run. And if you're short, you could start adding short exposure here. You can increase it all the way up to the top of the zone, but personally I would not add on anything above that uppermost part of that zone. In fact, at that point, you want to have a stop not too far above and start scaling out, unless something in the charts tells you to stick with it and give it a little room. But again, it all depends on your own risk tolerance, stop allowance, and your own entry price. So there's not any one area where I can say, buy here, short here, stop out here. It all depends on how you went into that position. And for you ES traders, or again, even if you don't trade futures, I think it's a good idea to keep an eye on the futures charts. You can get free real-time futures charts from investing.com, intraday charts, all that. So even if you don't have a futures account, it's easy to track what the futures are doing. And so the story on ES obviously is going to be very similar to S&P 500. You had this high back here. You also had a bearish rising wedge breakdown that set that gave us that correction there. That ended in a divergent low. Positive divergences at the lows. There was your rally there, and as I said in recent videos, just like QQQ, they looked almost identical up to this point because they both broke down there, and both set up in this basing pattern in late June, early July. Have both had divergent lows, both broke out and ran, and they look very similar up until recently. So what happened is QQQ, as we all know, the big FANG stocks, tech has been underperforming. So QQQ did this, came right back down, and NQ to that back test the top of that range and then bounce so far, but it's stopping really about this point here. So here's the disparity right now between NQ and SPY. So what's going to happen? Well, Who knows? We can continue to see sector rotation. Anything's possible, but here's what I'm watching for. You have a similar uptrend line right here, which was taken out today in ES. I drew that on NQ. And the big level, just like SPY, remember we had that previous high back here in June, early June. We tried at it again and failed. Tried at it again. Finally, the SPY broke out or ES broke out, and that former resistance level became support, and it acted again as support here. So we've had a lot of successful back tests, but that's still an important level. We're still in close proximity. That level's about 27.97, give or take, and that's what SPY or ES traders want to watch. So you can look at it glass half empty, glass half full, however you want to trade it. If you're looking to buy dips, pullbacks to dips, well, you can see we closed right on support now, or we're trading. This is a live chart. We can come back down, maybe hit it again. There's your opportunity to go long with a stop somewhat below if you're looking for a move to new highs. And if you're looking to short ES, if that level breaks and goes with conviction, especially a 60-minute close, then you might be able to get a swing trade all the way back down here to about 27.44. Again, the top of that recent range, and a lot of reactions right there. Okay, and that's it. It was really, like I said, not much more to update on the charts. As I went through in the beginning of the video, the markets were basically flat. Everything was down except QQQ due to Apple, but those that were down weren't down much. So nothing has changed from a technical perspective on the daily or weekly charts. So no reason to update those. All right, let's just keep an eye on these 60-minute charts, watch these levels, and best of luck on your trades.